Hi everyone, it's Grant Abbott speaking, and welcome to this session on temporary incapacity, what, when and how to use it from a self-managed super fund. Importantly, I was going to do a session on SMSF Death Benefits Trust, but what I'm going to do is I'm actually going to do a bit of an expose, a summary, a really encapsulated view of next week, a discretionary versus a leading member trust, versus a family protection trust and versus an SMSF death benefits trust. So I think if we look at that all in context rather than just one, because I've been drip feeding them out and I've been doing quite a few discussions with people, a lot of training sessions recently for firms on it. So it's probably a good time to actually bring the big four guns out to show you what is different for all of those. So what you have, that'll come out next Thursday. So if you're desperate to wait for that, it will come out. But with this temporary incapacity, I've been doing, for those of you probably well aware, I was the first one to ever devise a SMSF specialist course way back in 2001 on the understanding that I believe that it was coming from a teaching background and also from a legal background and a legal teaching background, that I could teach anyone the law and, more importantly, how to apply it. And so when you look at the old financial services standards in providing advice in a self-managed super fund, which I had a hand in basically building, it was always read, understand and apply the law, which we're going to do today. So we're going to have a bit of fun on this one. But look, this was always the specialist. The specialist, once I went through this section, people were going, oh my God, I didn't realise this could be done. There's so many bells and whistles to it. And I must admit, I did look at this going back maybe 7 weeks ago, for those of you around, that I did my 7 ways of accessing superannuation. One of the ones was obviously temporary incapacity, which I sort of touched on. And I saw my good mate Dan Butler referred to it this week on temporary incapacity. So, and that came up because someone asked me a question every Tuesday. For those of you who are LY strategists or licensees or I Love SMSF strategists, I have a session a Tuesday every week at 11 o'clock where you guys can just throw me questions. It's a real strategy round table, but if you want to get onto that, you just need to contact Sophia, who's Sophia at ilovesmsf.com, to get your name down, and then we start to shoot the breeze, and I show you how I start to think. But one of the questions came up was temporary incapacity. So I worked through it, and I was a little bit rusty, but it didn't make any difference. But I thought, oh, geez, this would be great, because it's one of those sessions that I think everyone loves at the end. So let's get into it. I'm going to give you my best. We've got case studies. We're going to read, understand, and apply the law. I'm going to show you how to use the system. I only just put it up an hour ago. Ash and the team put it up. But to give you an idea, on that strategy roundtable, I actually built the document in that space. It just shows you how good the Lightyear Doc system is. I can build it and was ready for test within 4 hours. And that's unbelievable, because I know when I was with Now Infinity, it would take 6 weeks, possibly even 6 months, because I'd have to liaise with the developers, and they were over in the Ukraine and all that sort of stuff. So, look, we've got a really good system, and encourage you to put more and more documents up on the system if you believe they need be. Anyway, let's not move around from there. So temporary incapacity is one of the, I think it's a fantastic strategy, and really COVID sort of hits us bang, right in the face. That it's sort of sitting there. Obviously, the numbers were the numbers that we expected. Hundreds of thousands of Australians dead never appeared, and effectively, what happened, it wasn't as bad as we first thought. But again, it starts to give it that idea about that incapacity side of things. So I want to explore exactly what that is. Industry and retail super funds could offer temporary incapacity, but as you start to see, it's very flexible, it's very malleable, and really we need to get it to operate. So, if I'm sick, by tomorrow, I can turn on the spigot, the temporary incapacity spigot virtually, and you as advisors should be able to do that. Whereas there's no way in the world you're going to be able to do that with an industry and retail fund. These things are like big behemoths, they just don't. They don't turn on a dime, and essentially that's where we really want to be able to go. But it's a fantastic tailored offering for any member of the fund, and you can bring someone who's outside the fund into the fund just to set up a temporary incapacity benefit if you want to do that. and it really commences as soon as the member's off work due to ill health, whether physical or mental. So the simple COVID now, and in fact, if you have a look, once JobKeeper finishes, there will be a lot of people who will have obviously depression, anxiety. I saw figures the other day that the prescriptions for mental mental pharmacies or mental chemicals, or as mental pills, I shouldn't say that, anxiety pills, etc., have really gone through. And in fact, the government's now offering, I think my daughter's you get 10 free psychology sessions. So out of that, that to me now focuses on that other area, which is the mental health. So look, it's a good opportunity. Let's have a look at it. Let's do a deep dive. I'm going to do a case study, and then what we can do is come back and rewind around that. And at the end of the session, I want to have a chat with Tim around about our estate planning month, and I've got a couple other little things there I want to really fire at you as well. So essentially, but it really needs administrative and compliance flexibility. So I'm going to show you how to actually do the document and start it up within hours of someone being noted as being temporarily incapacitated. Now, the goal of an SMSF for all of us is becoming a family SMSF. It's a vitally important strategy. So for temporary incapacity, we've got to make sure that the deed allows and enables it. The law is the law, so it's quite set in its ways, and we're going to have a look at that. And more importantly, the advisor knows what they're doing. So after you've been through the session, you're actually going to be able to say to a client, I can offer a temporary incapacity, but up until this present point in time, you may not have even been aware of it. So how does it work? So first off, we've got John and Sally, who are the parents inside a self-managed super fund. They're in their mid-50s, still got a few years off before they are retiring. John works, and Sally also works in the same business with them. Got their little daughter, Angel. She's one of three, but she's the eldest. She's age 22. You can see her there off over in Canada, overlooking the snowfields. She's currently snowboarding, and also in winter, and then during, she's not in Canada, she's in Colorado, sorry. But during summer, she does mountain bike tour guiding. So she's a bit of the adventurous type and is off overseas, so good luck. So this is the current balances of the fund. John's got 1.1, Sally's 800, Angel's 20, and the earnings of the fund currently are at $70,000, but there are no reserves at this present point in time. So the way it works is we've got to obviously be a member. And I'm just giving you the headline things now, then we're going to jump into the law and we'll have a look. So it must be a member. There has to be a cessation of work temporarily, and obviously that if you're just off work, it could be the broken leg that we're going to see poor old Angel's just had from her snowboarding accident. But again, it could just be ill health or was sick or whatever, just a really bad case of COVID or a bad case of the flu. Effectively, once you're off work, when we get the law, you'll actually see that's okay. Now, temporary incapacity, I'll look at the law, but essentially under the current rules is it can last. So, for example, little Angel here is at 22. It was very unlikely, but she could be paid temporary incapacity benefits up to age 65, which is her last retirement date. So she could be paid temporary incapacity benefits up to age 65. Whether the fund could fund it or not is an issue. But the temporary incapacity ceases when Angel would go back to work, if she becomes permanently incapacitated, dies, or retires or turns age 65. One of the big ones, as I was thinking, it sort of, I was looking at this morning, I thought, oh my God, what happens here around the enduring power of attorney? So, for example, let's say we've got Angel's got a balance here, but let's say she hasn't got a balance, which isn't a big issue. I'll have a look at that a little bit later on. But imagine if she had money in a retailer or industry super fund, which we wanted to roll over into mum and dad's fund, the Smith fund, the Smith family super fund, for her to start up a temporary incapacity income stream, because obviously the industry and retail funds don't offer it. The hard thing is if she's stuck over there, it might be hard to facilitate that process. So it's absolutely crucial, I would have thought, for all of your clients who've got children who aren't in the fund, and just as a matter of course anyway, for anyone who's got children, obviously if they're over 18, under 18, this your in your guardianship. Once they're over 18, there needs to be an enduring power of attorney put in place for them. And you'll find that with particularly our leading member funds, the leading member can appoint her as a member, so she doesn't even need to do an application form. As long as she consents, it's A-OK. So, and obviously, if the EPOA directly details that John or Sally, let's say it's John, can act on her behalf as the director, as her replacement director, Angel can be a member, but she doesn't have to be a director under Section 17A3B. So when we have a look at that, it's the EPOA sort of struck me because it's sort of one of those things that I was missing before in my temporary incapacity discussions. But make sure we've got an EPOA in there, absolutely crucial. Determination of income lost is crucial, because it's effectively what we're doing is the super fund's almost acting as an insurance company is providing a salary continuance, and that's the best way. I'm going to show you a little bit. I'm going to talk a little bit later on, if you remind me, why it's really important to talk to clients about salary sacrificing, and I'll talk about that. It's payable monthly. It can be payable weekly, but must be payable at least monthly. We'll get into the law around that. There's limited access from a member's account, but we could top that up, for example, with insurances in the fund, earnings, as you see down there, any insurance payouts, as I said, or any reserves if there happens to be any inside the fund. So we'll go through that. And then when we have a look at the tax of the member, it's actually not a superannuation benefit. So therefore all the concessional rules don't apply. So ordinarily, if she was able to access an income stream under preservation age, if she was able to do that, it would be accessible with a 15% tax offset. But because it's not a superannuation benefit, and I'll take you through the law, it's fully accessible in her hands, just under ordinary income principles. And you'll see the good little twist in the tail later on is the fund is actually going to get a partial tax deduction for any payments made, and we'll go through that. So let's have a look at the case study. So as I said, we've got little Angel. She's over 22 years of age, is in Colorado, working as a snowboard teacher during winter and a mountain bike tour guide in summer. She had an accident last week, came off her bike. So obviously the winter skiing season is finished, but some places over in the US are still getting snow, believe it or not. But obviously the fields are closed by breaking a leg in two places. She's going to be off work until winter season, starting in October. So she's without income. Now, this is important. Her employer and Angel do not have accident insurance, so she got one for herself. Her parents should have really paid for it anyway, but again, that's another issue. And the employer doesn't cover her wages, which were $500 per week with an average $400 per week tips. So she gets obviously quite a lot of tips, which is fairly typical of people over in the US. My current wife was working in Hawaii when I first met her, and Amanda was working, I think, for about $5 an hour. She worked at a place called Herringbone in Waikiki, but she would regularly work a 4-hour shift and come home with $400 in tips just for that night. So again, it's just the way that it happens over there. Now, John and Sally Smith are obviously fretting over their daughter. They'd love to get over there and go over to Colorado, drop everything to see that she's okay, help her out as parents would. But obviously with COVID, they can't do anything. So they're stuck and there's a burden of worry on them. They're members of the fund along with Angel. So what we need to do now is we need to go through the set of laws. So I'm just going to give you a summary here, then we'll go through and I'll tell you where we're going each time, because there's quite a bit of, it's funny because people would always say, oh, Grant, you would jump from here to there. Well, it's because it's just the way the legislation is written. It's very poorly written and it's not in one book. You actually have it in we're lucky I've got for those of you who are, really want to get into this, the Australian superannuation legislation is out, the 2020 version. So at least all the different acts are set in one place. But again, you still got to move around the act and know where you're going. So we need to start at the trust deed always. So I'll start at the light year docs deed and I'll show you where we're going there. We then go into the SIS regulations. So we need to go to the definition of temporary incapacity. And then we need to have a look at if it's in her account, what can be drawn out. Generally, minimum benefit standards under Regulation 5 or Part 5 of the SIS regulations, they must be maintained by the trustee of the fund. So that means it was basically used, put in there ages ago, because people used to forfeit benefits from their account to equalise monies between spouses, put it up into reserve or equalise benefits. Now, anything that's a minimum benefit is protected and you can't really draw down upon it. Of course, you could lose money on it, but you can't draw down on that amount unless it's from a conditional release. And we've got to look at the conditional release in Schedule 1 of Part 2 of the regulations as to what a temporary incapacity income stream, which then will wheel us back to a non-commutable income stream. So I'm going to talk temporary incapacity, but the technical term is a non-commutable income stream, which is boring and certainly wouldn't want to talk to your clients about that one. We'll then drift into ITAA 97. I'll show you that not a superannuation benefit, and then we're going to come back and look at the tax deduction for the payment of a temporary incapacity income stream. So we've got quite a bit to go through over the next 30 or so minutes. And then what we'll do is once we've done that, we then apply it to the case study. So let's go back, refresh our mind. Again, Angel's 22 years of age. She was receiving $500 per week or $2,000 a month. And she was getting probably $1,600 a month in terms of tips. So we'll have a look at both of those ones. So let me just drift out of there, and what I'll do is I'll go in and let's have a look at the light year docs deed. So you can see there I've got temporary incapacity income stream. I'll close out of that. We'll start it up again. What I'm going to do is just jump into my vault. And what I want to do is, I did this for one of our recent members who just joined up the other day, Acumen. You can see here the corporate trustee indeed upgrade to light year docs, which, look, if you haven't gone through that process, I met with a group the other day who hadn't done it since 2007, can you believe? The deeds were last upgraded. Honestly, people ask me, how often should you upgrade it? And if you look at the commissioner, so forget what Grant says, commissioner says it needs to be upgraded regularly and have in mind all the benefits of the members as well. So I'd go every like 2 or 3 years. In July, we're following, I think it's Super Central and DBA and a few of the other ones who are doing annual upgrades. So effectively we'll be offering that as well for our people. So if we have a look at here, the corporate trust upgrade and deed, I've already done all that. So all I'm going to do is just download the document there and that will pop up. So obviously we don't want to have a look at the constitution. That's not really relevant to the incapacity. Obviously we'd have to have the directors going in. I should have a look in there in relation to an EPOA. One of the things there is I'd want to have an EPOA over Angel. So I'd probably go out of there, and at some point in time, what I would do, and you can actually do this now with overseas addresses as well, we'll just put that in place. So I'd probably go through, she probably hasn't got that many assets, but what I would do is I would just go down, so it's in the estate planning. I would for her, it depends. So let's say mum and dad are in New South Wales. I'd do an EPOA in New South Wales for Angel anyway, because I'm sure she comes back now and then. So anyway, let's go through that process. I'm going to go down into the deed itself. So we've gone through the rules of the company here, and what I want to do is go down. Oops, sorry, here we go. We're going into the deed itself. So it's a pretty simple variation. Honestly, to vary the constitution and the deed takes no more than about 4 or 5 minutes. It's just so crazy that not for all those of you who are subscribers, you should be just doing this, getting everyone on the same platform so that you know exactly what's going on and you know what you can and cannot pay. So when we go down to you'll see there there's the deed of variation, the actual governing rules of the trust deed, and then you've got the PDS or your product disclosure statement that's sitting at the end. So we go down to the governing rules of the deed itself. Obviously, she's a member or she could be appointed as member. What we're looking at is member benefits, accessing and type. So that is Rule 6. So if I just drift down to Rule 6, and actually I'll go to Rule 7 first, which is all the defs, all the definitions, and let's have a look at what we've got here for temporary incapacity. So just going through that, scroll. Oh, there's SMSF Living Will coming out with one of those shortly now. That's a pretty new, exciting benefit. Probably we'll discuss that a little bit, I think, at that month with Tim and the estate planning. Anyway, superannuation income stream includes, subject to the super laws, a lifetime complying accounts-based pension, a non-commutable pension. You can see all that, but it's not it's got there a temporary incapacity income stream, and non-commutable is classified as a pension under these under the laws, but it's not the laws per se for income tax and also the SIS Act. It's just an income stream. It's not a pension, but we call it that. So when we come down to temporary incapacity, you'll see here, temporary incapacity is subject to the super laws and the fund retain its complying status. Any condition that the trustee determines to be temporary incapacity for the purpose of these rules, and includes where a member has ceased to be gainfully employed, including a member who's ceased to temporarily receive gain or reward under a continuing arrangement for the member to be gainfully employed due to ill health, whether physical or mental, that caused the member to cease to be gainfully employed, does not extend to permanent incapacity. This may include sickness of a limited duration where the member is not working. So that's fine. Temporary incapacity income stream is a super income stream, and really this just is going to paraphrase. You'll see here, you've got CPI doesn't have residual capital value. I'll come back to that because that essentially is a phraseology for a non-commutable income stream, which is required under the SIS regs. So we've brought that, we've brought effectively the SIS regs into the deed, and then let's go down and see what we can pay. So what we've got here is specific. So obviously start off with a general. So the trustee is authorised to pay or make a superannuation lump sum or super income stream, which is, remember, super income stream includes a temporary incapacity income stream for the purposes of these rules, from a member super interest where the member meets a condition of release, blah, blah, blah. Now, specific benefits payable by the trustee of the fund. If we have a look there, we've got the first one, where the member in the trustee's opinion is temporarily incapacitated. Remember, we just looked at the DEF on that one. They may commence a temporary incapacity income stream. We had a look at that as well, until such time as the member is no longer temporarily incapacitated, which may include a return to gainful employment, as that term is described on super laws, death, or permanent incapacity, or alternatively they turn age 65. So we've got the ability to pay temporary capacity. So everything is sitting effectively in the deed. So the deed gets a double thumbs up. And just check just go and pull up any of your deeds and just do a Control F, and then just see if you've got temporary incapacity in there. So what I'm going to do is bounce out of there, because now I'm going to go into the SIS Act. So I've got that sitting up here. So this is actually the SIS regs. So let me just go through. First, I'll start off part 1 of the regs. And you'll see here the definition of temporary incapacity in relation to members cease to be gainfully employed, including members cease temporarily to receive any gain or reward under a continuing arrangement for the member to be gainfully employed, means ill health, whether physical or mental, that caused the member to cease to be gainfully employed but does not constitute permanent capacity. So that's very much, actually, I'll just blow that up a bit because you've got to have some good, there you go. So that's very much the same as what is sitting inside the light year docs deed, obviously. So that's okay. So let's have a look and then relate it back to Angel. So is Angel temporarily incapacitated under the law and then hence the governing rules of the Lightyear Docs D? So you've got in relation to member, so Angel is a member, which is okay. Who has ceased to be gainfully employed, well, that's the case definitely. Including a member who ceased temporarily to receive any gain or reward under continuing arrangement. So at this stage, Angel is being employed by the tour guide, the mountain bike tour guide. She's off to the winter season, so she's not employed by them anymore. So that's it. She's just been effectively dumped out of that. So she's clearly ceased to be gainfully employed. But if they said to her, look, if you come back in a month or 2 or 3, or like 2 before the ski season starts, I will then re-employ you. In that instance, we're still covered there. So it could even go to a stage that, for example, with myself, obviously I'm not a good one because I'm over 60, but for example, a 30-year-old has come in with a breakdown, an anxiety breakdown. They're in their parents' fun. Then effectively they're off and they've had a nervous breakdown. They're off work for 3 or 4 weeks and they come back to work. Then bang, I mean, you can virtually pay this temporary capacity right from the start. So the issue is the trustee. So you can see here, there's no trustee determination, which is why we've put it into the D. That's the trustee can make that determination. Remember the difference? So that's where the shades of grey, actually, not the shades of grey, but the difference applies. So we've got our temporary incapacity income stream. Now, what we need to do is go through and have a look at the SysRegs part 2, which we had a look at. So again, temporary incapacity, we know what that is because we've just met that condition of release. Does everyone follow that one? So it's and this is the important, we're going to go through this. It's a non-commutable income stream, and we're going to look at that. So that takes me back to the other regs. Isn't it good to have me as a guide? Otherwise you'd be completely lost. Cash from the regulated super fund. So cash just simply means that it's being paid out. It's an income stream. So you need to meet the conditions of that. For A, the purpose of continuing in whole or part, and this is the important one, the gain or reward which the members are receiving before the temporary incapacity, and a period not exceeding the period of incapacity from employment of the kind engaged in immediately before the temporary incapacity. So let me just cover those couple of issues there, because they are, you know, this is item 109. This is right in the midst of where we're looking at. So the first one is we have to determine the gain or reward which the members are receiving before the incapacity. Now, in that one, when we have a look at it, we've got the gain or reward she receives. It doesn't say salary or wages, because what will happen is with temporary incapacity, it can also include someone who is self-employed. So in that instance, the gain or reward that we would be saying for Angel is not only her salary wages, but would also include her tips, because that is part of the reward. Now, we might, as trustee, average those out over a period of time, but currently we can see that she gets, on average, $900 a week, or around about $3,600 per month. So that's the first thing. So A is determination of $3,600 per month, and the payment coming out, this income stream, is really to ensure that she's continuing. Secondly, for a period not exceeding the period of incapacity from employment of the kind engaged in immediately before the temporary incapacity. So she was a mountain bike rider. So interestingly, and let me put this to you, you know, have a think about it. So let's say that she's a mountain bike rider, and then unfortunately her legs, she can't go and do mountain bike riding any further because it's just too painful for her. So she's given up that one. So does that mean that if she's given up that one and then she went and got another job, say an office job, that period of incapacity still applies? Do you look at it as being, same occupation? So effectively, is that saying that this temporary incapacity is from mountain biking, but if she went and did something else, she'd still be temporarily incapacitated from mountain biking? again, that would be my argument. But if you do come across that in your travels, please make sure you give me a call. I love, obviously, all of these sort of issues. So temporary incapacity. So what I need to do now is go back to our SIS regs, and I want to find out what a non-commutable income stream is. So again, I'm in SIS regulation, as you can see, 6.01. And I've got a non-commutable income stream here, which then follows, I call it a temporary capacity income stream under the deed, obviously. So it's a benefit that cannot be commuted, is paid at least monthly, so you can do weekly, doesn't have a residual capital value, so there's no capital amount at the end. It just simply means that once it's ceased, it just folds back into your accumulation account. It's such that the total amount paid each month is fixed or varies only for the purpose of complying with the Act and these regulations, and during any period of 12 months by a rate not exceeding either 5% or the rate of increase in the last CPI for a quarter to be published by the Australian Statistician before the end of that period of 12 months compared with the CPI published for the same quarter in the preceding year. So, so you can actually just, what you probably do, because CPI is crap, so you probably use the 5% per annum would be in the realm there. So they can be increasing. But it just shows you temporary incapacity or non-commutable income stream can last, obviously, beyond 1 year, which we're going to have a look at. So today, what we've done is we go in and have a look at, here. We've got through the simple case study. We've gone through the light year docs trustee. We've gone through the SIS regulations. Now we're going into the Income Tax Assessment Act. So I'll go back into my trusty little legislation. Again, sorry for dragging you around all this stuff, but it's just, unfortunately, it's the way that things go. So section 307-10, so I need to go there. And so what that says is, so this is a section which talks about what is a superannuation benefit. So if you have a look at item 1, which is typically for most of us, go up there, item 1. So you can see there's a few pages on this. A superannuation member benefit is a payment to you from a super fund because you are a member. Now, death benefit is a payment to you from a super fund after another person's death because the other person was a fund member. So there's different taxation laws around that, but that's not relevant to us because we want to go down to 307-10, which I'd highlighted for you before. So when we go down to 307-10, that's actually a section that says payments that are not super benefits. A payment of any of the following kinds is not a superannuation benefit. An amount payable to a person under an income stream because of the person's temporary inability to engage in gainful employment. So the payment we're going to make out to Angel, we've decided is going to be $3,600 per month. So that's the amount. So effectively, it's not a superannuation benefit. So when it comes out to her, all the concessional rules around superannuation benefits don't apply. So therefore, it's taxed as ordinary income. So the $3,600 would be taxed as ordinary income. Obviously, we'd have to be careful around that because she's a non-resident. Obviously, she doesn't get the tax-free threshold for that. And again, it's not going to be a big drama anyway if she is a member of her parents' fund because she's got such a low balance. The fund would still be an Australian superannuation fund. So that's the first one. So the next one we want to go to is now have a look at the tax deductions. So we know the accessibility in her hands. Let's go back and have a look at the tax deductions we've got here. For the first one, I need to look at, I think it's $295,460. Oh, let me know. Gosh, sorry. Let me have a look. $295. Oh, $291. I don't know how we got there. Getting just too excited about this stuff. So $295,460. Oh gosh, sorry about this. Having a bit of a nightmare. 295.1. Okay, so that's the contribution rules. Okay, hold on. Let me just go here. Okay, we're looking at deductions. So it's assessable income, blah, blah, blah. foreign funds, amounts excluded from assessable income. So that's always nice. That's your pension exemptions there. Some small fund assets, income from assets used to meet current pension. We all know that one. So that's all sitting there. There's a legislation for you. Now we should be getting up to deductions. Okay, other exempt income. Okay, there's deductions. Okay, so section 295.460 basically says section 295.465 about deductions for employment funds for insurance premiums, 295.475 for deductions for employment about future liability to pay benefits. So first off, we can have policy, but we're looking at that section there. But what I'm looking at is just paying straight out of the fund and all that sort of liability. So these sections apply to a superannuation death benefit. So there you go. So you can actually get a tax deduction in some instances for superannuation death benefits. Sorry, Hein, is that better if I actually talk a little bit closer? Bear in mind, all this is being recorded and will be a little bit later on. A benefit consisting of amount payable because of a terminal medical condition, which is not the case. A disability superannuation benefit, that's a permanent disability. And what we are is looking at this. A benefit consisting of an amount payable to an individual, Angel, under an income stream, a non-commutable income stream, because of the individual's temporary inability to engage in gainful employment, which we've already worked out under the deed and also under the SIS regs, the SIS Act, that is payable for no longer than 2 years, or if an approval under section 62 of the SIS Act is enforced for benefits of that kind, and the approval specifies a longer minimum period, that longer period. So the Commission has actually released an approval under 295.465C2, and it goes until age 65. So it used to be the 2-year rule. So hence, what that means is we can pay salary continuance and get a tax deduction for insurance premiums up to age 65, and likewise, these payments being made to Angel, as I said before, can go to age 65 unless she dies, becomes permanently incapacitated, goes back to work in the meantime. Then if we have a look at that, so what we can do is those payments can be made. Now, when we go through, there's the deductions for insurance premiums. When I have a look here, I won't drift into this to any great extent. I want to get into moving through self-insurance, and I want to get into the actual payments. So complying funds, deductions for future liability to pay benefits. So a complying superannuation fund can deduct an amount under this section for an income year if the trustee of the fund makes a choice under subsection 295, the choice applies the income year. And the choice simply means that they haven't got insurance in the fund in this year. So it's a either or. Even if there was salary continuance, if you decide not to choose the premiums, then you dip into this section. This is a great one for death benefits, because when someone dies, you're probably not aware, but if they're under age 65, the fund can actually get quite a sizable component of the benefits payable as deductible. So when I go down here, the benefit referred to in paragraph 295-460C, remember that's that temporary disability benefit. So the amount the fund can deduct is the benefit amount, which is your future service days. The benefit amount is, for this one, for a benefit referred to in 295-460C, is the total of the amounts paid during the income year. So that's the total amount. So we work out what the total amounts are, and then we're going to work out what our deduction is. Now, the future service days is the number of days in the period starting when the termination happened. So that was a couple of weeks ago for her. So we'll just say it's her 22nd birthday because she started work at age 21, or started being a member of the fund at age 21. And for a benefit referred to in 260C, the members became unable to engage in gainful employment, which is the case, and ending on the last retirement day, which is age 65. So her future service days, it's age 22, let's say, up until 65. So that's 43 days. Does everyone follow that one? So it's effectively, it's 43 days, 43 years. Now, ideally, we would turn that into days, but I'm just going to give you like a generality from that. So that's my top of the line, and it's not too bad. As you can see there, if it was someone such as myself who's over age 60, my future service days are very low. So, you know, the tax deduction would be fairly minimal. But then if we go down to total service days, is the sum of future service days and the number of days in, so it's obviously the future. For a benefit that is a lump sum, no. For another benefit, the period ending on the first day of the period to which the first payment of the benefit relates and starting on the earliest day of the day in which the member joined the relevant superannuation fund. And then, or the first day of employment if it's been rolled over, or you can actually pick it up here if there's a rollover benefit. So for her, she joined at age 21, which we've put in the facts. So her top denominator is going to be 43 years and her bottom denominator is going to be 44 years. But you obviously have to do it in days, but I'm just doing a round out there for you, and I'm going to get the old trusty calculator on that one. So that if there's $3,600 that is payable per month as an incapacity, and I want to look at where that's going to come from very shortly. So if it's $3,600, let me just get my little wee calculator. So it's going to be 43 divided by 44. So it's 97% times 3,600. So that effectively each month, the fund, out of the $3,600 payment, would get $3,518 as a tax deduction. So that's not a bad little contributions tax benefit there. So it's one that really most people aren't aware of. What I need to do now is I just got to go back to the SysRegs quickly, because when we have a look at it, it's, well, she's only got $20,000 and that's not going to last a long time. So this is the regs part 2. I want to go to the regs part 1. And what that does is I'll just go back to the earlier section, and you'll see here when we have a look at minimum benefits. So, okay, subject to these sections, a member's minimum benefits and regulated super fund are as set in the regulation. If the fund is an accumulation fund, the members' minimum benefits are all the members' benefits inside that fund. And we have a look at it. So primarily, when we have a look, we've got to protect our minimum benefit standards. That's really crucial. What I want to do here is have a look at, oops, sorry, I've just gone too far, 5.08, which relates to temporary capacity. So if I just drift down to 5.08, and again, it'll be in the slides, and I'll put that when it comes out to you as well. So sorry if you're getting your, a bit dizzy here. So we've got rollover benefits, 5.08. Okay, so 5.08 says how are minimum benefits to be treated. It is a standard applicable to the operation of regulated super funds and approved deposit funds that the trustee of fund must ensure that members' minimum benefits in the fund are maintained in the fund until the benefits are cashed as benefits of the member. So that is, for example, permanent capacity, death, retirement, other than for a purpose of the member's temporary capacity. So you can see here, there's an out there. So whatever the member's minimum benefits are, which is whatever's sitting in their account, effectively that must be protected. Now, if we just go down a little bit further, and you'll see there that, let me have a look here, sub-regulation 5.083 says, in addition to sub-regulation 1, a trustee of an accumulation fund may allow an amount of a member's benefits in the fund to be cashed as benefits of a member if the cashing of the benefits is for the purpose of the member's temporary capacity, that's okay, and the amount is not attributable to the member's member finance benefits, so whatever the member has put into the fund, and is not attributable to the member's mandated employer finance benefits. So that effectively is your SGC. So here's the deal, a couple of things. So inside our fund, we've got benefits we've put in, that's the member, and as a consequence of that, there'll be earnings on those. We've also got SGC put in by an employer and earnings on those. So they can't be used for any benefit unless we made a cashing, and they can't be used for temporary incapacity. So any other amount that's going into my account can be drawn upon for temporary incapacity. So that would be, for example, salary sacrifice above SGC, or for example, if we have a look at that, your salary sacrifice and obviously earnings, which again, it's not a bad thing, is that it's another little, not a big one, but it's nice to know that if you are talking to clients about salary sacrificing, as opposed to getting a distribution and then making a contribution into the fund. In that instance, then what we do is that salary sacrifice, from our perspective, can be accessed as temporary incapacity, provided you meet all those conditions. So it's just another big tick of why we should put in salary sacrifice, because we might be able to access it a little bit later on. So when we come around to having a look at the incapacity, I'll go back to the simple case study here. What I've got is a scenario that Angel's 22 years of age. You know, she started work where she's going to get $3,600 per month, and there's going to be $3,500 coming from or $3,518 will be tax deductible. Importantly, from that perspective, the status where we can get it from is we'd have to work out with Angel what her salary sacrifice amount is. Of course, John and Sally own their own business. They could get Angel to do some internet work, obviously, and pay her. They'd have to pay SGC, but anything over and above SGC, which can also include excess concessional, can pump up her benefit, which will then be taken out. Does that make sense? It's a pretty good one. So just let me go through that again. Angel's sick in bed, sitting in Colorado. She does work for mum and dad. And mum and dad do a full salary sacrifice, which is better anyway, because why would she, if you take money out of the family trust or the business trust, it's going to be taxed at non-resident tax rates. So what happens is, let's say $50,000 goes into the fund on her behalf, and then she's obviously got SGC on that package, which is $4,500. So what's that? So it works out $45,500 or thereabouts, or $45,000 will effectively be her superannuation. $25,000 excess, and that's added back to her assessable income, blah, 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 with a 15% offset. So that's not a bad thing. So what will happen is that'll pump up her members' benefits, which can then be taken down. So the trust will get a tax deduction for it, goes into Angel. Angel can then pull it out. It's assessable in her hands, which is okay. Remember, it's $3,600 per month, but then $3,500 will be tax deductible, which effectively will, if we have a look at it, that's probably going to cancel out a lot of the contributions tax. So it's actually a very, very smart strategy. Let me just build this quickly in front of you with the system. I'll just see, are you there, Tim, at all, or while I'm building this little strategy for everyone?
Grant, I'm here. How are you?
Yeah, good, thanks, mate. And how's your coffee? Hopefully it's coffee and it's not wine at this time of the day.
Mate, there's no wine until about 5 o'clock. So it's definitely one coffee, about to go make another black plunger coffee, keep me powering on.
I know. I remember when I was working at Infinity, I used to go and do lunches all the time, which is crazy. These days, I just can't do it because there's just so many exciting things and opportunities out there. You just don't want to waste a second. But while I'm building this, so I'm just going to go to the SMSF income streams. Everyone can see what I'm doing. It's pretty obvious. Now I'll start the document. So do you want to just go through and tell everyone about what we're doing in July, or what you're doing and how we can all leverage into it?
Yeah, thanks, Grant. Look, what we found through the COVID situation is you were one of the first ones to really pick up on, look, has everyone got their EPOAs done and their wills up to date? You know, we were going through a crazy period and none of us knew really what was going to happen. But that just really reminded everyone that unforeseen things can happen. It's not like you planned for it and you think you can get the docs done in time. You actually can't. And it just reminded everyone we've got to put aside the time to get these crucial things done. So, for example, I'm updating all of mine using all of my estate planning using Light Year Docs on the weekend. We had powers of attorney that were updated in 2014 and medical directives, and it's way too old. So that made us decide that we were going to make, with Change GPS and Light Year Docs, focus on the month of July as a real asset protection and estate planning masterclass month. And Grant, I know you've got a very big couple of days, I think on 14th and 15th of July, and we're really happy to be and thankful to be part of that. And as well with Change GPS, we're going to be running 4 sessions, 4 masterclasses on Fridays for 4 weeks in a row to take everyone through the start to finish of not just doing the docs, but how do you position to your clients? How do you charge for it? We've got a wonderful, it sounds wonderful, and this sounds crazy, it's a 25-page document that I've put together where I've looked at everything that Grant has released, and I've put an explanation to clients so they can actually get motivated to move ahead at good prices to get the work done. So we're covering off everything like the protector that Grant's put together, which we love, the whole estate planning side of things, protection for loans across entities, to protect working capital. And so we've got that document that'll be made available for Change GPS core members, but we'll demo it to anyone that wants to jump on board. And we'll go right through from how do we offer it to clients. The second week, we'll be actually using Grant's documents and doing estate planning for you and your team. Because unless you've done it for yourself, you can't do it for clients. Third week, we'll be doing for clients. And then fourth week will be how to follow up and how to reposition to review things in 12 months' time. So that's something we're really looking forward to. There'll be a lot of comms coming out on that soon. But I think July, that'll be the first time accountants get to have a breath after tax planning and trust distribution resolutions and everything else. That's the perfect time to engage our clients for everything that Grant's talking about here and to use the fabulous docs and Light Year Docs.
Yeah, and I think the important thing is that on the 14th and 15th of July, when we come out, that's more of an industry conference around for accountants and planners. What can we do going ahead? And we've got some amazing speakers, across. I know Tim and I are going to do a smash out session on our top tax and super strategies for the start of the year and really setting up for the end for the whole year, which will be exciting. And I know, Tim, I'm coming in doing a bit of an estate planning session, but again, I'm only going to touch on it, whereas Tim obviously does a lot of commercials, which is fantastic. So that'll be that masterclass. And Tim's also going to do a session with a few leading lights around business planning for the year and how he works out what his budgets are going to be. So that's going to be fantastic. But we've got a cocktail session. We've got Ryan Gambit, who's an amazing Australian Olympic athlete, coming in talking about motivation through COVID. And remember, at some point in time, COVID is all going to stop. And then that's going to be an interesting position where to be. So, look, that'll be really exciting, and thanks for that, Tim. It's going to be really great, and this is a new way. This is the new way for I think a lot of accountants and particularly planners to be looking after the entire suite of affairs for their clients rather than outsourcing, bringing it in, making sure it's legally compliant, and then you're A-OK.
Thanks, Grant. And look, I think it's fantastic that you're doing these weekly sessions, and just encourage all the accountants that are on there that it's so vital that we just keep up our communications and support to each other. I know we've got a Change GPS community Facebook group that anyone's welcome to join. I know Grant posts in there as well. Myself and my entire team, we listen to Grant's webinars every week. We jump on board, and if we're in a client meeting, we'll record them and play them as part of our training. It's just, and I'd encourage everyone here, if you're an owner or a partner, make a compulsory CPD for your accounting team. Even though some of us might be a little bit beyond them, just the repetition, it gets in their heads, they start to understand the bigger picture where these things all fit, and then they become better advisors. So this truly is the best CPD that you can get. So I just encourage everyone, get your team involved.
Well, it's actually strategy CPD and not just crap.
Yeah, exactly right. Yeah, this is practical, absolutely practical. Yeah.
And how many times you've sat through CPD by some licensees and you think, oh my God. And you always can tell anyway, because everyone gets their phone out. Anyway, look, here we got a temporary incapacity income stream for Angel. You saw me, I built it, how long did it take? I mean, what was it, 4 minutes? So this is application by Angel coming in. Now, I want to go through a couple of things. So the member hereby requests the trustee commence a temporary incapacity income stream as defined under super laws and funds. Any such income streams will be paid from members' accumulation account as allowed under SIS, which we just talked about, plus the discretion of the trustee, any fund earnings. So remember, we went back, the fund has got $70,000, so we can tap out. I gave you 3 strategies. We can tap out Angel for amounts over and above SGC. Make sure that possibly John and Sally with their family trust start to employ her straight away, tip it over. In fact, just go for broke because they're going to get a tax deduction and then it's going to come out to Angel anyway. So that's the best way for the family to effectively look after it from a tax perspective. And then the final way is if you've got earnings or reserves. Remember, we've got $70,000 of earnings. So she's going to be able to, and remember, this is only short term until she gets that winter break. So look, it's pretty easy from that perspective. So we go down and do all the thing, the date of commencement. So we just heard from the client, it's today. So bang, we've got a result for it today. It's going to be sent out today and they can start paying tomorrow. So temporary incapacity, $3,600 per month. Remember, it's $3,500, which is tax deductible. Signed by the member, Angel, and she gets witness. So you're about to do all that, get that digitally signed. So that's no drama because that's under the SIS Act, it's under federal law. So you're absolutely fine on that one. Binding trustee resolution, commencement of temporary capacity income stream, 11th of June. So she's applied. Next stage is they've had a meeting, bang, and they're ready to pay it. So Smith Family Super Fund, Angel Smith, age of member 22, attended by John Smith. And we've got, I think it should have actually been Sally. I must have dropped that off as well. So 5 Smith Street. So the trustees received from member to request a commencement there. The trustee, on advice from the fund's advisors, notes that any temporary capacity income stream is to be paid until the member notifies the trustee that blah, blah, blah. Any payment may be subject to PA pay-as-you-go and could be partially tax deductible. So you want to go down that. When's it going to commence? It's going to commence today, $3,600. And then we've got, the 2 directors there. Now, what I've got there is, although Angel's a member, she has an EPOA that she's given to John. So although she's a member of the fund, she doesn't need to be a director. In fact, it's something that you should all have a look at. The first thing I look at is who should really be directors of a corporate trustee. So that's a document, get it all signed, and then off and running and can start paying those amounts, just fitting with that non-commutable income stream. And we're pretty well right. So let's just jump to the last slide. As Tim said, we're going to be looking at that estate planning. Next Thursday, what I'm going to do is I'm going to bring all the suite of trusts. I'm going to show you the difference between the 4 of them, our discretionary trust, our leading member trust, our family protection trust, and also our SMSF trust. Sorry about the typo, that's a bit of gone. Our virtual strategy summit coming on the 14th and 15th of July. That'll be out tomorrow. The cost on that is going to be virtually nothing. But if you want to get 11 hours CPD, then you'll need to make a payment. So again, but it's still not going to be nothing. I think it's $149, which is the early bird price. And don't forget, every Tuesday at 11 a.m, if you're one of our strategist members, just get on to Sophia at ilovesmsf.com and book your place. And then we go through a great strategy roundtable then. Anyway, that's probably enough from me. It's Grant Abbott signing off, and thank you all for turning up, and I'll see you next week for the big trust smash out.